In a dramatic turn of events, China has begun offloading billions in U.S. debt following the imposition of new tariffs by the Biden administration. This move has sent shockwaves through the global economy, raising concerns about the future stability of financial markets and the potential for rising interest rates. Financial expert John Williams provides a comprehensive analysis of these developments, underscoring their implications for both the U.S. and global economies. Record Dow Jones high amid economic uncertainty. The Dow Jones Industrial Average recently hit an all-time high of 40,000, suggesting a robust market. This milestone might lead some to believe that the U.S. economy is thriving, with record low unemployment and a strong job market. However, Williams argues that this apparent prosperity masks underlying vulnerabilities. The record high could be a precursor to significant economic headwinds, as suggested by the actions of major players like China and central banks worldwide. China's massive sell-off. China's recent sale of $53.3 billion worth of U.S. Treasuries and agency bonds marks a significant shift in its investment strategy. This massive offload is a clear indication of China's intent to diversify its holdings away from American assets amidst escalating trade tensions. According to Bloomberg, China's move includes reducing its treasury holdings through custodians such as Belgium, which disposed of $22 billion in U.S. treasuries during the same period. This shift is occurring despite the potential for the Federal Reserve to enter a rate cut cycle, highlighting the strategic nature of China's financial maneuvers. Impact of new U.S. tariffs. President Biden's recent announcement of sweeping tariffs on Chinese imports, including a 100% tariff on electric vehicles, has further strained U.S.-China relations. These tariffs, which also target solar panels, steel, and aluminum, are designed to protect U.S. industries but have prompted swift retaliation from China. By selling off U.S. debt, China is signaling its dissatisfaction and leveraging its significant holdings to put economic pressure on the United States. This retaliatory measure complicates the U.S. government's need to sell approximately $1 trillion in debt annually until 2030, potentially increasing borrowing costs if new buyers cannot be found. The role of gold in economic strategy. Amid these economic tensions, central banks and financial experts are turning to gold as a safe haven asset. Notably, Michael Burry, renowned for his foresight during the 2008 financial crisis, has significantly increased his gold holdings. Central banks, including those in China, are also buying gold at record levels. This move suggests a lack of confidence in fiat currencies and a preference for tangible assets that tend to perform well during economic instability. Historical data supports this trend, with gold prices soaring during past crises, such as in the 1970s and 2008. Implications for U.S. debt sales. The U.S. government's need to sell large amounts of debt annually is becoming increasingly challenging, with major buyers like China stepping back. To attract new investors, the U.S. may have to raise interest rates, which would have broad economic implications. Higher rates would increase the cost of borrowing for consumers and businesses, potentially stifling economic growth. This scenario raises the specter of stagflation, where high inflation is coupled with stagnant economic activity, a situation that can lead to prolonged economic hardship. Stagflation fears and job market challenges. The potential for stagflation is a growing concern. Higher interest rates could exacerbate the current economic situation by making loans and credit more expensive, reducing consumer spending and business investments. This, in turn, could lead to increased job layoffs as companies cut costs to cope with reduced revenue. The cost of living, already a strain for many, would become even more unbearable, leading to widespread economic distress. Strategic investment moves. In light of these developments, investors are advised to diversify their portfolios to mitigate risks. Safe haven assets like gold, silver, and land are expected to perform well during periods of economic turbulence. Holding cash for short-term opportunities while investing in stable assets could provide a hedge against potential financial instability. Diversification helps protect against the erosion of purchasing power that can occur during inflationary periods. Reshaping the economy. China's aggressive sale of U.S. debt and the imposition of new tariffs are reshaping the global economic landscape. As the U.S. navigates these challenges, the potential for rising interest rates and economic instability underscores the importance of strategic financial planning. Investors and policymakers alike must remain vigilant and adaptable in the face of these unprecedented changes. The moves by China and central banks signal a cautious approach to the future, prioritizing stability amid increasing economic uncertainties. Impact on global financial markets. What do you think? How will China's sale of U.S. debt impact global financial markets in the long term? What measures can the U.S. government take to mitigate the effects of rising interest rates on the economy? Effect on consumers. How might the imposition of new tariffs on Chinese imports affect the average American consumer? What role will gold and other precious metals play in future economic strategies? How can individual investors best protect their portfolios in times of economic uncertainty?